as an accountant, this standard you need to know it because you can't prepare your financial statement or your published account without this particular standard. The standard we are coming to look at today is we are coming to look at a non-current asset standard. Okay. Whenever an entity bought plants, what are some of the standards do you think they can use to account for this particular non-current asset, which is plants? What are some of the standards do you think they can use for this? What are some of the standards do you think can be used to account for the acquisition of the plants?
IAS 16.
Okay, that is one of, I say, what are some of the standards? So the first one is IAS 16. What again?
IAS 23.
Why are you saying 23?
Because it's also part of the standard that is used to account for non-current assets.
Are you sure? The 23 is what?
23 is borrowing cost.
Yeah, so assuming this is not a qualifying asset, we are buying this asset in its original state. We are not coming to do any operation to it. Like we are buying it as a plant, as a finished good. So there is no way borrowing cost can be applicable to this place. Borrowing cost is only applicable to qualifying assets.
What of IAS 40?
40, yes, 40 is also part. IAS 40, which is investment what? Property. What again? There is another one.
IAS 36.
IAS 5. Hey, no, IFRS 5.
No place. Those standards are subsequent standards. We are talking about
Okay.
you are buying the plants right now. What are some of the standards you can initially use to account for this particular plant?
Okay.
So, okay, the other one is not popular. It's inventories. All right. So what I'm trying to say is that for you to know which of the standards that you are going to use to account for the acquisition of non-current assets, you have to know the purpose for the acquisition of the assets. You have to know the purpose. You see, if you have land, one company can acquire the land just to build office on it. The other one can also acquire the land, which they will be giving to people to farm on, and they will be getting rent every month or every year. One company can also be into selling and buying of what? Land. So you can see that with the same land, we are having different purposes. And the various purposes is going to tell you which standard you should use to account for it. If you are going to use the land for administrative purposes, like you are going to build on it, then in that case, the land can be used for property.
IAS 40. No?
You are going to build on it. You are going to build office on it. So in that case, you are going to use the land for administrative purpose. So in that case, the land can be accounted for using what? The popular one.
IAS 16.
Okay, property, plant, and equipment. Okay. Assuming you acquire this land for rental purpose, like you lease it to people, you give out to people, people will come and farm on it, or people will come and bid on it and they will put office in it. You'll be getting rent every year or every month. you can see that you are not the one who is going to use the land. So since you're not going to use the land to benefit yourself, you can't use the system for it. You are going to use which one? Which standard are you going to use?
IS 40.
IS 40.
40. So if you are into real estate company where you buy and sell land, which standard are you going to use to account for the land?
Inventory.
IS 2.
That will be inventory. So the initial treatment of a non-current asset is dependent on its purpose. So for you to know which standard you should use, you have to know the purpose that you are acquiring the asset for. So today, what we are going to look at is that we assume that we are acquiring the asset which will be used in the company for more than a year, and the company please, if you're not talking, Macarena level. Okay. So today we are going to assume that the company is going to acquire the asset and they are going to use it for their own benefit, the asset will also be used in the company for more than a year. So in that case, we are going to look at the IS 16, which is property, plant, and equipment. Property, plant, and equipment. Okay.
Sir,
Yes, no.
is it IS2 or IS20? The third one.
It's two. 20 is government grants.
Okay.
All right.
Okay.
Okay. So whenever you acquire an asset for the first time, you have basically three standards to decide which of them that you are going to use to account for that particular asset. But the rest that are impairment and those one are subsequent standards. They are subsequent standards that you are going to use to account for the non-current assets. All right. So what we are coming to look at today is that we assume that we are going to acquire the asset and use it for ourselves. We are not going to give it to anyone and we are not going to sell it. So we are going to have IS 16. How does the standard define property, plant, and equipment? Property, plant, and equipment. Any asset that is owner occupied. Any asset that is owner occupied. If they say owner occupied, doesn't mean you are going to use it for personal use. No, the company itself, because it's not the owner. You as an individual, you're not the one buying the asset. You are buying the asset for the company. So we are looking at the company as the owner. So if the company is going to occupy the asset themselves, then that asset should be classified as property, plant, and equipment. And if the asset is going to be used for administrative purposes, and it will be more than a year, it will be in the company for more than a year, the asset should also be classified as property, plant, and equipment. But the question now is, when you plant this one, a mango tree, okay, assuming you are planting a mango tree, this one, some of you haven't heard about agriculture before, but it is well, don't worry, it is well. Let's come here. How are you going to classify the mango tree? How are you going to classify it?
We'll classify it as IS 16.
Why are you saying that?
Because the mango tree is more or less like a dara plant.
Okay.
And then, and its fruits will be classified under biological assets.
Okay. Hey, so no, it seems like you're on top of issues. So.
This is it.
You're on top of issues.
But is biological asset not IS 41?
Yes.
Yes.
It's under agriculture. Okay. But you can see that what I want to say is that any asset any asset that you are going to buy or you are going to manufacture with the purpose of using it to generate income or with the purpose of you to run your business effectively or efficiently will be classified under property, plant, and equipment. So any asset that you are going to acquire or any asset that you are going to manufacture that will help you in the production of what you are producing, that particular asset will be classified as what? Property, plant, and equipment. Look at the mango tree. The mango tree just like what? It's just like an asset that is helping us to produce what? Mangoes. We are just using it to produce mango. So in that case, we are not having a mango tree for its own purpose, but just to help us produce what? Mango. So in that case, we assume that a mango tree is what? Is a fixed or a non-current asset, which will be regulated using the IAS 16. So the IAS 16 talks about assets which are owner occupied or which will be used for administrative purposes, and also bearer plants. So this one, the bearer plants, one of them is the mango tree. You can also have orange tree. All those plants that will be used in the production of what? Another product or something like that are classified as what? Property, plant, and equipment. Property, plant, and equipment. So if you have a mango tree, the mango tree, we are going to account for it using property, plant, and equipment. If you have orange tree, it will be accounted for using property, plant, and equipment. So we are saying that any asset that is owner occupied, it is being bought and the owner is using it themselves. But this particular asset should have a useful life more than a year. In that case, we are saying that that asset is qualified to be classified as property, plant, and equipment. If the asset will be used for administrative purpose, which have a useful life of more than a year, we also say that that particular asset is classified or is qualified to be classified as property, plant, and equipment. But the issue now is, when do you put plants on the face of financial statement and add 5,000 to it? What do you have to see before you go to the financial statement of your company and write plants there and put 5,000 attached to it? What do you have to see? There's something that should inform this your decision by putting the 5,000 in the books of the company. In the books of the company. Assuming you are the financial accountant of your company, and you just one day you just come to work and you saw a car there. So you saw a car there and you just open the vehicle or the fixed asset book and you put car there, 10,000, without asking any question. No, you can't do that. You cannot do that. There should be something telling you that this car belongs to the company or this car is for visitors who are coming to the company. You can't just see a car on the premises and go and recognize car in the books of the company. There should be something telling you whether you should recognize this particular car in the books of the company or not. And I'm asking, what are those things that you see before you can go ahead to put the car in the books of the company? What are some of the things that you see before
Ownership documents.
you will see ownership what? Documents.
Document.
So we have to see the ownership documents. Okay. What else? Ownership document and what?
If it is a lease, then you look out for the contract that spells out the lease, whether it's for operation purpose or finance lease.
Okay. Okay. Okay, that's nice. All right. So we look at the contracts. What again? What again? Financial reporting
Then
is
the period,
the
the
period of,
lifespan.
okay, the lifespan. The financial reporting student, we look at the recognition criteria for an asset. Anti-Kafi, have you forgotten?
No, when it's when you can reliably establish the cost,
When you can reliably establish the what? The cost.
measure the cost.
Okay. When the cost can be reliably measurement of the cost. Okay. What again?
When the future economic benefits
When there is,
associated with the assets will flow to the entity.
hey, relax for me. When future, I don't have a good memory, so you have to be saying it one. Future,
That the future economic benefits
future economic benefits
associated with the assets will flow to the entity.
relax more, senior. Associated with the assets, will flow
Flow to the entity.
to the entity. Okay. Why are you saying these plenty things, my brother? Okay. So the first one, you have to see whether the company owns the assets. If you own something, it means that you have control over the thing. If we say that you have a control over something, what is the meaning? They say I have control over you. I have a
That's
control.
unrestricted access.
Okay. So if I'm saying I have control over you, what is the meaning? If I have control over you, what is the meaning? It means that I can dictate your movement. I can dictate certain things for you. If you want to go somewhere, I can say that don't go there. So I can tell you how you should live your life. So if the company is controlling the asset, it means that the company can tell how the asset should be used. They can control how the asset should be used. They can tell you that, okay, this car, don't use it for this. Our car, we don't use it for thoughtful. No, you can't use the car for thoughtful. It means that the company has control over that particular asset. So when you are trying to direct the usage of the car, you are trying to tell the people how they should use the asset. You see that you have a control over the assets. You have a control over the assets. Sometimes you can have control, but you don't have ownership. Is that true? Sometimes you can have control, but you don't have ownership. Is that true?
Yes.
Yes.
Yeah, why are you saying that is true?
In cases of lease, you have control, but you don't have ownership.
Okay. I'm not even looking at it from that angle. You see, my girlfriend right now, I have control over her, but I don't have ownership. You get the issue. So I'm not talking about that side. Okay. But since you want to relate it to accounting, we don't have any problem. So in terms of lease, you have control over the assets, but you don't have ownership. The asset is not for you, it's for someone. At the end of the lease period, you have to send the asset back to what? To the legitimate owner. To the legitimate owner. So if we are talking about these issues, we are talking about recognition criteria. If we say recognition, what is the meaning? Recognition. What is the meaning? Recognition. Recognition.
To consider something as belonging to a particular class. So you recognize it as belonging to a particular group of things or people.
I want to see the person talking. So the person should talk again.
I'm saying that
Okay.
to recognize something is to notify or to be aware of the thing's characteristic and classify it to belong to a particular,
Okay. Anti-CAFI, recognition. If they say recognition, what is the meaning?
recognition.
How to account for the assets?
Exactly. Thank you, my sister.
Who is saying that what she said is correct?
Yeah, recognition has to do with including the item on the face of the financial statement.
Exactly. Are you doing a file? Okay. It means that you are raising my this thing high. Okay. Thank you very much. Recognition means you putting the item on the face of the financial statement, or the item appearing on the face of the financial statement. So if you see plants on the face of a statement of financial position 50,000, it means that they have recognized the plant. So recognition means the thing appearing on the face of the financial statement. That is the recognition. That is the recognition. So the recognition criteria for all assets is that the cost of the asset should be measured reliably. It's not that if we are asking you how much did you buy this asset, then you have to be telling us we should go to Kofi, go to Ama, go to, like, you have bought it in a black market. So it's just like phone. Someone has stolen the phone, the person will say, oh, bring this money. You can't estimate the actual cost of the asset or the true cost of the asset. But if we can go to an open market and decide, okay, this plant is this amount, it means that the cost can be measured with what? Reliability. We are not suffering to ascertain the cost of the assets. But if the cost cannot be measured reliably, that is why we don't recognize gifts. Gifts. We don't recognize gifts. Assuming it is not involving money. Someone is giving you maybe mobile phone. No. The company cannot recognize that because you didn't pay anything for it. So we can't measure the cost. Although you can say that this thing, if you go to the market, is this amount, but we can't say that you have paid this amount for it. All right. The next one is that it is probable that future economic benefit associated with the.
What if it's cash? What if the gift is cash, in the form of cash, money?
When a gift is cash to the company, then it's either we take it as a donation, so we can recognize that particular cash as donation.
Thank you, sir.
All right. All right. So the next one is that it is probable that future economic benefits associated with the usage of the assets will flow to the entity. The meaning is that if you are using the asset, whatever benefits you will be getting from the asset will be coming to the company. So if you're using the asset to deliver product to your customers, it means that whenever you send the goods to the customers, who is going to benefit? You are selling, so you are going to be benefiting from the sales. But if you are using the asset and the asset is not benefiting you, it's benefiting someone. Maybe you are using the asset. Okay, this is why we have work and pay. Work and pay. Okay. You see, work and pay, the rider or the driver cannot boast of the car as his own because the benefit is not coming, the car is not giving him any benefits. Although he'll go to work and get some small money, but he is not the main beneficiary of the car. So he cannot boast of ownership. He cannot boast of ownership. Another one is that there's a sufficient evidence that the car or the asset actually exists. You are saying that you have plants, which is 10,000, but we can't see the plant on your premises. So where is the plants? There is no evidence to show that you have the plants there. There is no evidence to show that you have the plants there. So whenever these things are there, you can go ahead and recognize an asset. You can go ahead and recognize an asset. Let's come to, if you want to recognize the asset for the first time, how do you determine the cost? If you want to recognize the asset for the first time, how do you recognize the cost? How do you recognize the cost? So we call something initial recognition or initial measurement. So initial recognition or measurement. Okay. Okay, so the initial recognition and measurement also depends on the form that the asset is what is coming. You see, we have so many forms that a company can have an asset or a non-current asset, for that matter, PPE. So if you want to know the initial cost, initial amount that you are going to attach to the asset, the cost is also dependent on the form in which the asset is coming. So the first one is the company can just buy the assets. So we can also have what we call the outright purchase. Outright purchase, where the company is just buying the asset as a final product from a seller. So let's assume that you are buying car from UK. You are buying car from the UK. The first thing that you are going to pay for is the cost of the car itself, which is the purchase price of the car itself. So you have the purchase price of the car itself. It is likely that you are going to incur other costs, isn't it? What are some of other costs that you can incur to have the car delivered to you? What are some other costs that you are going to incur to have the car delivered to you?
Shipment fee.
So you can also incur shipping what? Costs. What again?
Clearing cost.
You can also incur what you call the clearing cost. What again?
So the duties that to be
Duty
paid.
cost.
So you can also pay the import duties. Okay. Which other costs are you going to incur?
You can look at the insurance on the car.
Insurance can be in
Registration.
Okay, registration. You can do insurance after you have started using the car. Okay. But we are going to look at the cost that you are going to incur before you start using the car. Okay. So the registration.
Cost of dismantling and assembly.
Okay. If you have any issue with you dismantling the assets, then you can have dismantling costs. Dismantling costs.
Testing costs.
You can also have testing costs. Okay. What again?
You can also have borrowing costs. In the case of
You can
manufacturing or
also
construction.
have borrowing costs. But the borrowing costs will be applicable to only manufactured what? Assets. But this one we are buying the assets. So the borrowing cost will be expensed. The borrowing cost will be expensed. So what we are saying is that before you can attach value to the assets, there are a lot of things that you are going to take into consideration. Okay, the standard says that the initial cost of the asset or assets should initially be measured at cost plus any direct expense which is attributable to the assets. So that direct expense can be installation cost, it can be shipping fee, it can be import duties, it can be delivery cost, anything that is any cost that is directly incurred on the asset. If not for buying the asset, you shouldn't have what incur what the shipping cost and this thing. If you are not buying the asset from outside, there will not be any issue of shipping cost, duties, and this registration. You are not going to incur them. You are incurring this cost because of the what? The asset. So if you are going to initially recognize the asset, you take the asset at its purchase price if you have any discounts. If you have any discounts. How many types of discount do we have?
We have two.
These are
Trade discount.
trade discounts and what?
Cash discount.
And cash discounts. Okay, which of them do you think we can talk about in case of initial recognition of the assets? Which of the discount do you think we can use?
Cash.
Trade
Trade
discount.
trade discount.
Why are you saying that we should use a trade discount?
I think we are using the trade discounts because it's a discount given because you are making purchases, but the cash discount is given when you do early settlement.
Okay. Okay, you have the point there. You have the point there. Okay. Why do you think we should use the trade discount, not the cash discounts? Why do you think we should use the trade discount, not the cash discounts? Okay. Let me just leave it like that so that you go and search for it. Okay. So initial measurements, we are talking about, we have so many ways that the assets can come in. The first one is outright purchase, where the company will just go to the market and buy
Sir,
the asset.
please, with regards to the cash discount, is it not given because of bulk purchase? But in this case, we are buying just one item.
I think
I
cash is
don't know if
given
that.
when you are paying outright.
If,
You know, so if let's say you go and then others are credit, even with normal purchases that we do. When you buy something you are paying in a month's time, the price is different from somebody who is paying cash.
that no, that one
You
is
understand?
that one has to do with time value of money. So the company is indirectly adding interest element, but you don't know. Because you are going to hold their cash for a number of time. If you should pay them that money, maybe they should have invested it and get some more profit on whatever they are going to buy. So since you are going to hold it, they are going to consider the time value of money.
So why do people give cash discount?
The cash discount is just there to entice you to pay on time. So cash discount is always given on credit purchases or credit sales. They are giving you this thing so that you be forced to pay on time. This is given to sometimes to maybe entice the customers to pay on time. So cash discount will always be given when you buy on credit. When you buy on credit. But trade discount, the discount that you are going to take at the workplace by paying cash immediately is the trade discount. Okay. But a trade discount too is something that will be there forever. It is something that will not be dependent on how much quantity that you have bought. If it is 5%, even if you are buying 1 cedi, you are going to enjoy 5% on the 1 cedi. Okay. But the car discounts, they are giving it to you to pay maybe early and enjoy it. They are giving it to you to pay early and enjoy it. And the car discount is just like a revenue item. Car discount can be given maybe more than 3 times in a year. But a trade discount, as soon as it's there, the company cannot change it. If it is 5%, it's something that is for everybody. So the cash discount is just like a revenue item. It's just like a revenue
So
item.
can it be likened to rebate?
Is it?
Rebate.
The cash?
Yes, the cash discount.
Rebate as in?
Okay, it's fine.
Yeah.
Okay, so what I know about the trade discount is that it is normally given to encourage customers to buy more or do more purchases.
We can't hear you, Senior.
I am saying that trade discount I know is normally given to reduce bulk purchases.
We can't hear you.
Hello?
Yeah, I can hear you now, Senior.
Okay, so I was saying that I've worked with a company before that trade discount is only allowed for customers who are buying in bulk. So with what you are saying, I'm a bit confused.
Confused in which of the parts, which area?
The trade discount aspect,
Okay.
yeah, because I heard you saying that it is always there and the company cannot change it. As if they say it's 5%, it's always there for anyone who wants to buy.
Okay.
So provided somebody is buying just one item and another person is buying, let's say, 5, and the same 5% is given to all.
The five
Don't you?
the 5% will be given on the amount that you are paying, not the item that they will say 10 cedi, 10 cedi for everybody. No. So you enjoy more discount if you are buying more.
Okay.
So it's not that the 5% is 10 cedi for, they say if the 5% is 10 cedi, they will give 10 cedi to everyone. No. The 5% will be calculated on amount that you are going to pay. The trade discount is just like the promotion that they have been running every year. They will say if you buy this, you will get this. So they are reducing their amount by 5% or 6% on every purchase that you are going to make. That is like trade discount. That is trade discount is nothing like discrimination. No, it's a cash discount that they will give to some people that they should pay within time. If you don't pay, then you won't enjoy it. But what I'm saying is that the cash discount is just like a revenue item because cash discount can be given maybe 3 times or 4 times in a year. So it's treated as revenue. But a trade discount is like a capital item, whilst the company can give a trade discount once in a year. So it's just like a capital item, something that will not happen regularly. So we always use the trade discount, not the cash discount. So if you are giving a cash discount in the question, treat it as a revenue to profit or loss. Treat it as a revenue to profit or loss. All right. Do you have any question before I'll move on to the next issue? Okay. So
No, you can continue.
okay. So if you are buying the assets outright, you go to the market and buy the assets. The standard is saying that the cost of the asset, the initial cost of the asset should be the purchase price less any trade discounts, plus any direct cost incurred on bringing the asset to the premises or to its intended state for use. So any cost that you are going to incur on the asset before you start using the asset, that particular cost should be added to the value of the asset. So if you buy the plants, any cost that you are going to incur before you start using the plants, and the cost is directly attributable to the plants, that cost should be added to the cost of the assets. But any cost that you are going to incur after you started using the plants, that cost should not be added unless the cost will improve upon the efficiency of the asset or will also extend the useful life of the asset. So when you have a question and they say the company purchased this and this, and they have incurred certain costs, ask yourself, these costs, are they incurred after the company started using the asset, or they are incurred before the company started using the asset? If they are before and they are directly attributable to the cost of the asset or to the purchase of the asset, they should be added to the asset. But even if they are directly attributable to the cost of the asset, but you incur them after you started using the asset. Another one is the repairs. One of those costs is repairs. One of those costs is insurance. One of those costs is maintenance contracts. maintenance contracts. You see, sometimes they will give you a question that, okay, the company has entered into a contract with a maintenance company to be doing maintenance for the asset every 5 years. No, don't be tempted to come and add the maintenance cost to the assets. It's just like the company is paying the maintenance cost in advance. So what you are going to do is that the maintenance cost or the maintenance contract cost should be treated as a different asset because it is going to be for 5 years. So it will be like a prepayment that the company is making. But if the asset useful life is 5 years and the maintenance contract life is also 5 years, don't say that their useful life are the same. So you are going to add the maintenance cost to the assets so that you depreciate them at once. No, the company might be using revaluation model to account for its assets. If the company is using revaluation model, then how then are you going to separate the maintenance cost from the asset itself before you revalue it? So whenever there is a contract, maintenance contract or something, if it is for more than 3 years, that particular contract should be treated as a separate item and should be amortized over the contract life. So sometimes you can see a question, they will give you the cost and they will tell you that the company has entered into a 3 years maintenance contract. Maintenance is not going to do anything to the car. If you are maintaining your maintaining your car, it will not increase the useful life of the car. It will not increase the useful life of the car. If the car is taking 10 people, no matter how you maintain it, it will still take the 10 people. Nothing is going to happen to it. And you can't start maintenance for the car before you start using it. No, you can only do maintenance after you started using the car. So the maintenance cost is a cost that is incurred after you started using the assets. And the maintenance is not going to improve upon the efficiency of the car or the capacity of the car. If the car is taking 20 people, the car will still take 20 people. So the maintenance cost or maintenance contract, even if it is for 10 years, it will never be added to the cost of the asset. It will never be added to the initial cost of the asset. Repairs, it will never be added to the cost of the asset. Insurance, you can only insure the asset if you start using it. But if the insurance, you are going to insure the car before you start using it. The question now is, how often do you do the insurance? Okay, some people, what they will do is that before they will start using the car, they are going to insure the car. But the question is, how often are you going to renew your insurance? How often are you going to renew your insurance? The insurance payment, is it just one money and that is all, you're not going to renew it again? If you are going to be renewing the insurance every year, it means that the insurance is a revenue item. It's a revenue item, so it cannot be added to the cost of the asset, although you will insure the asset before you start using it. But the insurance is something that is going to occur often, every year. It's a revenue item. Therefore, the insurance cost can never be added to the cost of the asset, the initial cost of the asset. But any cost that you incur directly on the asset before maybe you start using the asset, that particular cost should be added to the initial cost of the asset. So I'll give you the list of the costs that can be added to the initial cost of the assets. So the first one is, if you are buying the asset, we have the purchase price less any trade discounts. Any trade discounts. The next one is, if you have installation, assuming it is solar panel, you have to install it before you use, so installation cost. We also have import duties, if there is any. Import duties, if there is any. Import duties, if there is any. We also have delivery or handling costs. So we can also have testing costs. We can also have non-refundable taxes, non-refundable taxes or indirect taxes. any other cost. We can also have the dismantling cost if this asset is under lease where you are going to dismantle the asset, or you are going to use the asset for a number of years, and after that one you are going to restore the land to its original stage, then you'll be having issue with the dismantling cost there. I'm thinking someone should ask why it is non-refundable taxes. Why it is non-refundable taxes? Why should it be non-refundable taxes?
It is not refundable taxes because GRA usually will not refund any tax that you've paid. They will, in the form of cash. They will only use it to credit you.
Even if they are going to refund it, you can't add it.
Okay.
The question can give you refundable taxes. There can be a question that they will tell you the refundable taxes. We don't use the refundable taxes, and I want to know why. What I know is that we don't use it, but I don't know why. Yeah, Sinatete. Sinatete, are you there?
Yeah, I'm here.
Yes. I want to know why we don't use the refundable taxes. We don't use the refundable one. We use a non-refundable one.
At the end of the day, the refundable one will come back to you.
We'll come back to you. Okay.
Yeah. So
Tina, I can't hear you. At the end of the day, the refundable one will come to you.
yes, because even if it's with GRA, it's credited to your account, and that lessens your burden. But then the non-refundable taxes forms part of the cost of the asset.
Okay. 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 All right.
Okay, so I also think that they use the non-refundable because when it's refundable, then it equals zero. It cancels itself out. Money goes out, at the end of the day, they give it back to you. So it's like we haven't incurred any cost.
Okay.
Thank you.
All right. That's nice. That's nice. That's nice. Okay. You see, whenever we have the refundable, it's just like maybe you are lending money to someone. That's all. It's just like advance payment, which person will pay you back. By the non-refundable, it means that it's a tax that you are paying that you are not going to take back. So it should form part of the asset because it will not be subtracted back from the cost of the asset. But if you're adding the refundable one, assuming the total cost of the asset was, so assuming the total cost of the asset was 50,000 and the useful life was 5 years. Out of this, 5,000 was for refundable taxes. Now you are calculating the depreciation on 5 years. It means that every year you'll be 10,000. In the third year, the company now refund the 5,000 to you. How do you account for this? How do you account for this? You see that the issue will become complicated for you. The issue will become complicated for you. So the non-refundable one, we just treat it as an expense, hoping that maybe one day it will come, which will be treated as income, All right. So this is the first form that the asset can come in. If the asset is outright purchase, what happens is that you take the purchase price, add any direct cost that is incurred to bring the asset to each stage of what? Each stage that the company want to be before they will start using it. If you have dismantling cost, you add it. Another form is what we call self-built. Self-built is where the company is manufacturing the asset itself. So if the company is manufacturing the asset itself, what are some of the costs that they are likely to incur when you are manufacturing the assets yourself? What are some of the costs that you are likely to incur when you are manufacturing the asset yourself? If you're manufacturing the asset
Is
yourself,
it
what is
cost of raw material?
okay? Cost of raw materials because you're going to use raw materials to okay. Cost of raw materials,
Labor.
labor cost.
Labor.
What again? What again?
Maybe storage cost.
Storage.
No, that one.
Expense.
You see, the two major costs is the raw material and the labor, but we have other costs there. Someone mentioned a cost today and I said that is only for qualifying assets.
Borrowing cost.
Borrowing cost. This case, you are manufacturing the assets yourself. So if you go for a loan to manufacture the assets, that particular interest relating to the period that the assets is being manufactured will be capitalized as part of the asset cost. We can also have any other expenses, any other overheads that is directly attributable to the construction of the assets. So maybe you have done some packaging and some other things, or there's a depreciation or administrative cost. That administrative cost was incurred because of the construction of the asset. If not for the construction of the asset, that portion of administrative cost will not have been what incurred. So any other indirect cost that is directly attributable to the construction of the asset should also be added to the cost of the assets. Should also be added to the cost of the asset. So maybe the people, the engineers that you are using, you have rented a place for them and you are paying rent for them. It means that the rent will also be part of the what? The asset will also be part of the cost of the asset. Because if not for the construction of the asset, there won't be any engineer in the company. And you won't be paying rent for those engineers too. So the rent will also be a direct cost to the asset that you are manufacturing. So any cost that you incur as a result of the construction of the assets should be added to the cost of the assets. But let's come to the cost of raw material and labor. The question will always give you information. If you don't take time, you will end up coming up with the wrong cost of the assets. You see the cost of raw materials that we are going to use.
Linus, your question again.
Yeah, I didn't ask a question. I'm coming to say that the cost of raw material and labor is not all the cost of raw material and labor that we include. No. You see, you bought a raw material 50,000, but you were able to use only 45,000 on the project. Are you going to take all the 50,000 or 45,000?
You take only the 45,000.
45,000.
Okay. So the question will always give you the total cost of raw material. Then they'll ask you there was unused raw material on the site. We only look at the cost of the raw material used on the project, not the total cost that we have incurred. Are you okay? So if you are given this one, they'll always talk about what unused material. The unused material cost should be subtracted from the total material cost to get the material used on the assets. The labor cost too. You are going to have a situation where the labor or people, the workers will be paid for not working. They will be paid for an idle time. You can see that the idle time was not used on the construction of the what? The assets. So we only look at the cost that was incurred on the construction of the asset relating to labor. So if they are using 50 hours, what was the cost for the 50 hours that they used on this one? But if they are paid 55 hours, it means that they were paid for 5 hours, which is an idle time. They didn't use these particular hours for the construction. So therefore, the cost relating to these 5 hours should not be added to the cost of what? The assets. So the question can also tell you that, okay, because of this, there was a loss of labor hour and the people were paid for this one. No, those hours was not used on the project. So the cost for them should not be included. So if the question is saying that the labor, they are paid for 55 hours, and there was an added time of 5 hours, it means that they use only 50 hours on a project. So it's only 50 hours. The cost of the 50 hours, that will be added to the cost of the assets. That will be added to the cost of the assets. So whenever you are having a question on the self-built assets, you should be mindful of which cost you are going to include and which cost you will not what include. We can still have a dismantling cost over here if the assets will be all the assets will be dismantled at the end of its useful life. At the end of its useful life. All right. Let's look at the next form. The next form can be through what? Leases. Through leases. Through a lease, the company can also get the asset through a lease. If you don't have the money to buy, you can go and rent the asset to use for maybe 3 or 4 years. But the lease that we are talking about over here is a finance lease, where the risks and control relating to the lease period will be passed to the lessee. So we are going to look at leases. We are going to look at leases. But this one will be we are going to look at this one under the standard itself, IFRS 5, with 16 or 15, no. It's 16, okay. That's 16, leases. So we are going to look at the leases under the leases itself. But you can also acquire asset through a lease. But what I'm coming to say right now is that a company can also lease uncompleted what? Building. A company can lease uncompleted building. So before they will use the asset, they have to come and complete the building themselves. So assuming the lease was 5,000 Ghana cedis, but they have spent 15,000 to complete the construction of the building. What will be the initial cost of the asset? How much are they going to recognize the asset in the books?
20,000.
20,000. Okay. So even if you are leasing, where we have to discount the lease payment to find the right of use and lease liability, you can also lease a uncompleted what? Assets, where you come and spend money to complete the asset yourself. We are saying that any cost that is incurred on the asset before it is ready for its intended use should be added to the initial cost of the asset. You can see that uncompleted building, you can't start using it from this state. So you have to incur costs on it. So that cost you are going to incur should form part of the initial cost of the assets. The initial cost of the assets. You can also lease an asset and you incur delivery costs, import duties, any other direct costs. Those costs should be added to the initial cost of the assets. The initial cost of the assets. Another form is what we call sales and leaseback. Sell and leaseback. So sell and leaseback has to do with a company selling the asset to a buyer and still leasing the asset back from what? The buyer. And this is also under leases. You are going to look at this one under leases, where the sale is, where the transaction is not a sale, or the transaction is a sale. How do we account for those ones? So the two will be dealt with under leases. Another form is where we have exchange. Where we have exchange. You can also get an asset through exchange, where I need plans and someone has a land, but the person also need a plants and I also need a land. So what we do is that we just exchange the two assets. But if that happens, how do we recognize this particular transaction? So assuming the asset that I'm giving out, the value is 5,000. The one that I'm receiving is 7,000. How am I going to recognize this asset? Am I going to say that the asset that I'm receiving, which is 7,000, I'll recognize it at 5,000? Or what amount am I going to put there?
7,000.
So that will be 7,000. Okay. Assuming I cannot measure the market value of the asset that I'm getting, what will I do? What value will I attach to the asset? To the one that
I
I'm
think you
receiving?
use 5,000.
It will be 5,000 because I'll just assume that the asset that I'm giving out and the asset I'm receiving, they are of the same what? Value. So if you cannot determine the market value of the fair value of the asset that you are receiving, then you recognize the asset that you are receiving as the carrying value of the asset that you are giving up. But if you can determine this one, it's either you are going to have a gain or you are going to have what? A loss. Are you okay? So that is all about the initial recognition of the asset. The cost that you are going to include in the cost of the asset depends on the form that the asset is coming in. Depends on the form that the asset is coming in. Let's look at the effect of subsequent expenditure. 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 Okay, the subsequent expenditure, we are talking about expenditure that you are going
But
to.
please, is it different or I can't hear the word well? I
Subsequent
only hear
expenditure.
that. Okay, please. Thank you.
Subsequent expenditure. All right. The subsequent expenditure that we are saying that after we started using the asset, we have incurred additional expenditure on the assets. This expenditure can be either revenue expenditure, or it can be capital what? Expenditure. Okay. What do you mean by revenue expenditure and what do we mean by capital expenditure? Revenue expenditure, capital expenditure. What do you mean by that?
So with revenue expenditure, like the expenditure will be incurred annually or frequently, but the capital expenditure is a one-time expenditure to make on the asset.
All right.
Thank you.
Okay. So assuming we have done repairs on the assets, would that be added to the cost of the assets?
No, repairs will not be added to the cost of the asset.
Okay.
It
What
will be a revenue. It's a revenue expenditure.
Okay. What about maintenance?
Maintenance
is
revenue
equally
expenditure.
revenue expenditure.
What about extension to building? Extension to a building.
So extension to a building,
capital
or
because
if
it increase the capacity of the building.
yeah, and then I think replacement of part also. I mean, if you have a plant and you replace a part to a certain threshold with respect to the cost, that one too is capitalized.
Okay. What about changing of an engine of a car?
It's the
It's
capital
a
expenditure.
capital expenditure because without it, the car cannot function.
Okay. So the issue now is how do we, whenever there's the subsequent expenditure is expenditure that can be, or that will be incurred on yearly basis or annually basis. It is expensed. It is taken to profit or loss accounts. But if the expenditure is going to improve upon the efficiency or the capacity, or is going to extend the useful life of the asset, that particular expenditure should be added to the carrying value of the asset as at the day that the expenditure is being incurred. I will explain what I mean. Okay. If you are changing an engine, okay, it means that when you are changing the engine, the old one will not be there again, isn't it? So you are going to take the old one from the car. So what you have to do is that you have to ask yourself, what is the carrying value of the old engine that I'm changing? So if the total value of the car is 50,000 and you have changed the engine, the new engine now is 10,000. Okay, it means that since the old engine is going, the car will no longer worth what, 50,000. Am I correct? Since the old engine
Yes.
is going, the car will no longer worth what, 50,000. So you have to ask yourself, out of this 50,000, how much is relating to the old engine? Since you are ascribing the old engine, it means that it will go with the carrying value too. So assuming the carrying value is 7,000, it means that the car itself is 43,000. So since you are now bringing the new engine, the new engine cost will now be added to what? The cost of the car. Then the new value of the car will now be 53,000. So whenever you are doing a replacement, what you have to do is that you have to ask yourself, at the date of the replacement, what is the carrying value of the item that I'm replacing? You have to determine that and take it from the carrying value of the whole asset at the time that you are doing the replacement. Then you cannot add the new value of the parts that you are bringing. That is how we account for the replacement or the extension. The extension too, we only add the extension amount to the carrying value of the asset as at the day that the extension is done. As at the day that the extension is done. All right. We are saying that any cost that you incur to bring the asset to the stage that the company wants it to be before they will start using it, that particular cost should be capitalized, should be added to the initial cost of the assets. Assuming you went to the assembly to obtain a license, and this license will be renewed every 5 years, but the asset that you are having is going to last for 20 years. Okay, before you can start using the asset, you went for a license, and the license will be renewed every 5 years. Without a license, you can't use the asset. Are we going to add a license cost to the cost of the assets, or how are we going to do it?
Yes, we'll add it since it is an expenditure that is incurred before the use of it.
But the useful
And
life
the
of
further without it, it cannot be used.
the useful life of the asset is 20 years, but the license will be renewed every 5 years.
Wow.
So should we go ahead? I'm sure that you didn't hear the 20 years and then the 5 years.
Yeah.
Yes. Can we recognize?
Is there? Should we add the license cost to the cost of the assets?
Since the period are not the same, it can be treated as an expense.
No, please. You are paying for 5 years. You can't take all the 5 years to 1 year.
It's true. Oh, there will be prepaid aspect.
Yes.
Or for that of the 4 years.
Okay. So what do we do? You can know that we are taking the license because of the someone's listening is giving a bad signal. Okay. So how do we do it? We say that any cost that we incur before the asset will be ready for its intended use should be added to the initial cost of the asset. And the municipal assembly people are saying that without a license, we can't start using that particular asset. So we should count for the license. But here is the case, the useful life of the asset is 20 years, and the useful life of the license or the license will be renewed every 5 years. Should we go and add the cost of the license to the cost of the assets, or what are we going to do?
That please, if the company add the cost of the license to the asset, in 5 years' time, the cost of the asset can be treated as an upgrade or an improvement, since the company will need the license in order to be able to operate the asset. If not, the asset will have no use.
Well, I think the 5,000 should be treated separately. It should not be added to the cost of the asset,
Why? Why should we treat it separately?
because this is more or less a fee to operate. You understand? So we can own the machine, we can install the machine, we can have access to the machine without this cost. We can only not operate as a business without this cost. And this is for every 5 years. So in year one, we expense what we need to expense and then record the 4,000 as a prepayment. Then do same until the end of 5 years, then we go back and we renew the license. So I don't think it should be added to the cost of the asset.
Okay, that is nice. That is nice. Okay. Based on what I said, it shouldn't be added because the asset and then the renewal period are different. They are 25, 20 and 5 years, 20 years, 5 years. They are different. But you can add it when they are having what? The same what? Useful life. If the license will be renewed after every 20 years, it means that the license and the useful life of the asset are the same. And you can go ahead and add it. And you can only add that one too. If the useful life are the same, you can only add it if the company is using maybe the same method for accounting for the license and also the asset. Companies, they have two models to account for property, plant, and equipment. So if the company is using revaluation model, it means that they also have to adopt revaluation model for the license. But here is the case, it is 5 years and 20 years. So what you are going to do is that you treat the license more like an intangible asset. You treat it as an intangible asset separately on its own and amortize it over 5 years. Then the asset will also be depreciated over 20 years. So you are going to treat the two as a separate item. But if the license is a one-time payment that you are making for the license, then the cost can be added to the initial cost of the assets. Just like building permits. Building permits. Sometimes if you are building, they will say stop work. They have been writing something on the wall. Okay. So that permit that you are going to pay is a one-time this one. So you can add the cost to the initial cost of the asset. But if it is subject to renewal, then you have to treat it as a separate item, like maybe an intangible asset or something like that. All right. Okay, let's look at what we call subsequent measurements. After you putting the 50,000 attached to the asset in the books at the date of the transaction, you see that at the end of the year, the company is going to prepare financial statements. So the transaction happened. Let's assume the transaction happened on 1st January 2020. Okay, the company accounting period is January to December. So the time that they bought the asset was January 1, 2020, which was 20,000. Okay. At December 31st, would the cost of the asset still be 20,000? Would the cost of the
No.
asset still be 20,000?
No,
It will be what?
It will depreciate.
It will what?
it will be 20,000 less depreciation.
Okay. Okay. But I can also tell you that the figure can be the same or it cannot be the same. Okay. It will only be different if the company is using the asset. it will only be different if the company is using the what? The assets. But if they are not using the assets, what will happen? If they are not using the assets,
I think the value will remain the same.
the value will remain the same. You can only talk about depreciation if the asset is in use. It means that if the asset will be used for 10 years, as soon as you have used 1 year already, it means that the efficiency has reduced by 1 year, left with 9 years. That is the idea about the depreciation. But if you're not using the assets, it means that if you want to operate, it's a new asset. Still, you can use it for 10 years because you haven't started anything with it. But in this case, we are assuming that the entity is using the asset because they bought the asset to be used. So after they have used it, the value will not be the same again because the efficiency has reduced by a year. So the subsequent measurement, we talk about what? Depreciation. We talk about depreciation. We have so many methods of calculating what? Depreciation. But basically in the exam, it will be a reducing balance method, or it will be a fixed installment method, which we call the straight line method. Sometimes it can also be a unit-based method where they will give you the total unit that the asset can produce and the unit that the asset has produced during that particular year. Or they can also give you the number of hours that the asset can use, the total number of hours, and the hours that the asset has used for that particular period. So you will do that and you take the depreciation expense to statement of profit or loss. So the subsequent measurement, we have issues about depreciation. We have issues about depreciation. So the depreciation can be straight line method or it can be reducing balance method. And I hope that all of us can calculate what? Depreciation, isn't it? I hope all of us can go about issue of depreciation.
Yes.
Okay. Okay. So I want to talk about another issue concerning the subsequent measurements. You see the subsequent measurements? The subsequent measurement, the company can decide to keep the asset at what? Okay, the financial reporting people, we have looked at the measurement basis where we say that we have what we call the historical cost, the market value, the fair value, and those ones. The company can decide to keep the asset at its original purchase price and depreciate it over the useful life. Or the company can say that at the end of every year, we will go to the market and ask ourselves what is the value of the assets in the market now and how much are we keeping it in the books. So they will be using the market value at the end of every year. So under the subsequent measurements, we have the company have two models to choose from. We have what we call the cost model, and we also have what we call the revaluation model. Under the cost model, the asset is being kept under. All right, before I move, I want to ask a question. Does land depreciate?
No, but it
No, please.
appreciate.
Okay. I like the way you're answering the question that no. Kafi, before I want to say something. Does land depreciate? Kafi is not there. Yeah. Auntie Joyce.
If only we can estimate the useful life of the land, then we can charge depreciation on it. But if you cannot estimate, then there will not be depreciation.
Okay, that is nice. That is nice. Okay, that is nice. You see, those people who are saying that land does not depreciate, if you should go and lease the land from someone for 5 years, would the land be with you forever?
No.
So what will happen? It means that you are going to use the land for 5 years, isn't it?
Yes.
So the benefit will be exhausted in 5 years. So you have to depreciate the land. Are you okay?
Okay.
All right. So we have two types of land. We have leasehold land and freehold what? Land.
Yeah.
For the leasehold land, it will always be depreciated because the lessee is not the original owner of the land. The example is the mining companies. The mining companies will go to maybe, I don't know, the people that they normally go to. Is it the Ministry for Environmental something something? They will go there for concession. After the concession period, they will not have access to the land again. So if they are preparing their financial statement, it means that they have to be depreciating the land over the concession period. By land which is for you, we assume that the land will be there forever. That is what we call the freehold land. A land being owned by the company itself. That land will be there forever. Even if the company is not there, the land will still be there. But a situation where a country where maybe every 10 years there will be an issue of earthquake or flood or something. Even if you are the original owner of the land, we can depreciate the land because we know that after 10 years, the land will not be in its original form again. So we are going to use this land for only 10 years because after 10 years, there might be issue of earthquake and that particular place might be damaged. So if you live in a country where the country is prone to these natural issues, earthquake and those kind of things, the company can depreciate the land because they know that after every 20 years, there will be an issue of earthquake and the company will not be there and the land will not be in its original stage or the land might not even be there. So they can depreciate the land. But if nothing of that sort is going to happen, we assume that the land is going to be there forever. So for freehold land, we don't depreciate it. But for leasehold land, we depreciate it because the land will be used by the lessee over the useful or over the lease period. So after the lease period, the lessee will now hand over the land to the original owner. So in the books of the lessee has to depreciate that particular land. Let's come to cost model and revaluation model. The cost model, we are saying that we are keeping the asset at its original cost, then we subtract depreciation or any impairment from it. So if we bought the asset at 50,000, in the books, the asset will still be at 50,000. The only thing that is going to reduce it is depreciation or accumulated depreciation or any impairment loss that the land has suffered. But if you are talking about revaluation model, a revaluation model, we are saying that at the end of every year, the land will be revalued to its market value. The company will go and ascertain the fair value or the market value of the asset and now bring it to the market value. So at the end of every year, we place the market value of the asset. So if you are using revaluation model, it is likely that at the end of every financial year, the value of the asset might increase or might what? Decrease. So under the revaluation, what happens is that you can have what we call a gain, or we can also have what we call a loss. So at the end of every year, go to the market, determine the market value of the asset, compare it with the value that you have in the books relating to the asset, which is the carrying value of the assets. It might happen that the market value is higher than the carrying value and you are having a gain. And it can also happen that the market value is lower than the carrying value of the assets and you might be having a loss. So with the revaluation model, we have what we call revaluation loss or revaluation gain. We have revaluation gain, or we have a gain. There is a gain when the revalued amount is higher than the carrying value of the assets. And there is a loss when the carrying value is higher than the revalued amounts. Okay? When there is a gain, how do we account for it? And when there is a loss, how do we account for it? The accounting treatment for these two is determined by if there was an initial or there was a previous revaluation or there was a previous gain or loss relating to the same asset. But for the first time, if you are doing the revaluation for the first time, the issue is, let's assume that our revalued amount from the market is 50,000 and our carrying value is 40,000. What is happening?
You have a gain of 10,000.
There is a gain of what? 10,000. Where would this gain go?
To go to other comprehensive income.
Why should it be other comprehensive income?
Because it's the first one. So this is the first revaluation gain. If there were a previous, maybe a loss or something, probably to offset it. But because it's the first one, that's why you send it to other comprehensive income. So that's my own take on it.
Okay, thank you. Auntie Joyce.
Okay, it means that we get a gain not in our usual business activities. That is why it should be other comprehensive income.
Okay. So this particular thing is not something that is coming from our ordinary business what activities. Okay. You see, if you go to profit or loss, you see the profit or loss, the items that we see there are items that the company will actually what realized, or they are the actual thing that is going to happen. But you can see that the revaluation gain over here, we can actually have the revaluation gain when the asset is no more there. When the asset is no more there. But since the asset is still there, it means that the gain will be realized over the useful life of the asset. Over the useful life of the assets. Okay. So when there is an initial gain where the revalued amount is higher than the current value, the gain will be taken to what? Other comprehensive income. Other comprehensive income. So assuming the revalued amount was the 40,000 rather, and this was the 50,000. What are we going to have?
Revaluation loss.
A
Revaluation
loss
loss.
of 10,000.
And that will go where?
Expense.
That will be expense because there is nothing in the other comprehensive account that we are going to set this loss against. So for the first time, if it is a loss, revaluation loss, send it to profit or loss accounts. And for the first time, if it is revaluation gain, send it to other comprehensive income. Some people, they like doing the double entry. So the first one, let's look at the first one. The first one, it was a gain. Let's pass the double entry for that. 40,000. And this will be a gain. So in the books of the company, the asset is how much? Before the revaluation, what is the value of the asset?
The value of the asset will be 60,000.
4,000.
4,000.
4,000.
No, it was 40,000.
40,000.
Okay. So now the value has increased to how much?
To 50,000.
50,000.
So what do we do to the assets?
You're debited.
The asset will
Debit the asset.
Debited
asset.
by 10,000.
So we debit the asset 10,000 and
Yeah.
credit what? Other comprehensive income
Other comprehensive income.
by 10,000. Are you okay? Okay.
Yeah.
Upon revaluation, the old asset is no more there. The 40,000 will not be there again. The new value of the asset now is what? Is 50,000.
50,000.
So if the useful life of the asset is 15 years, then it means that the 50,000 will now be depreciated over what? 15 years. Upon revaluation, the carrying value of the asset is no more there. The asset is now reborn with a new amount. So it is the new amount that will be depreciated over the remaining useful life. But if the useful life has also been revised, then it means that the new amount will now also be depreciated over the new useful life. Okay, let's look at what we talk about subsequent revaluation. When there's a subsequent revaluation, what do we do? When there's a subsequent revaluation, what do we do? Okay, let's assume that that was in the first year. In the second year, the revalued amount, the company did a revaluation again. The revalued amount is now 40,000, and the carrying value is now 47,000. What is happening? There's a loss of what? 2,000. Okay. The first one, there was a gain of what?
10,000.
10,000. So in
10,000.
actual sense, we are making a gain of how much? In actual sense, what is the actual gain that we are making on this particular asset?
8,000.
8,000.
It's 8,000. So what do? We have to take the 2,000 to other comprehensive income to cancel the initial what? 10,000.
10,000.
Okay. So when there is an initial, when there's the first time revaluation, if there was a gain and the gain was taken to other comprehensive income, and the subsequent revaluation, there was a loss. If the gain in the other comprehensive income can cancel all the loss or can absorb all the loss, then we write the loss against the what? The gain. But assuming the loss over here is 12,000. Assuming the loss is 12,000. Okay. It means that we are, in actual sense, we are making a loss of 2,000 on the what? On this particular asset. Because we have 10,000 first, now we are having a loss of 12,000. So the net loss is what? 2,000. Okay. What we normally do is that what is the portion of the loss that is included in other comprehensive income? It is 10,000, isn't it? So we go and take that 10,000. So the remaining 2,000, which is a loss, where will it go?
An expense.
It will go to profit or loss. Profit or loss. The same thing is for if the first one was a loss, the second one was a gain. We take the loss to profit or loss first. So if there is a gain now, it means that we go and reverse the what? The loss that we have taken to that particular side. That is about the revaluation aspect of this one. What normally happens is that upon revaluation, some companies might decide to realize the revaluation gain over the useful life of the assets. Let's look at this. Let's look at this. Let's look at this. Okay. Let's just use some assumed figures. Okay. Assuming the cost of the asset was 50,000 at the time that it was bought. The useful life is 10 years. At the end of the first year, the asset was revalued and the revalued amount was let's assume that the revalued amount was 55,000. Okay. Let's assume that the revalued amount was 55,000. So this is the beginning of the year. At the end, for us to find revaluation gain, we need to do two things. The question is, we ask ourselves, what is the revalued amount as at the day that we are doing the revaluation? The next question is, what is the carrying value of the asset as at the day that we are doing the revaluation? Assuming we are doing the revaluation on December 2022, and this is at the beginning 2022. So we are doing the revaluation at the end of the year. So we have to ask ourselves, what is the carrying value of the asset at the end of the year? We compare it with the revalued amount and know whether we are making a gain or loss. So what will be the carrying value? What will be the carrying value?
Value be 45,000.
45,000.
Okay, how do we get a 45,000?
It will be 50,000 divided by 10. which will give you 5,000. Then your 50,000 minus your 5,000 will give you 45,000.
Okay. So 45,000. So this is the carrying value, isn't it? All right. We can now find our revaluation gain or loss. So the gain will be calculated as the revalued amount minus what? The
carrying amount.
The carrying amount. Okay. So the revalued amount is 55,000 minus the 45,000. What will be the gain? Okay, let me make this one 60,000 so that the remaining useful life will be 9 years, isn't it? I want to make it so that if we divide, we can get an absolute figure. So 9. Let me make this one 63,000. Let me make this one 63,000. Okay. So let me make this one 63,000. So what will be the gain?
18,000.
Okay, the gain will be what? 18,000. Okay. Let's go to the next year, which is 2023. What will be the depreciation now?
So the depreciation will be the 63,000 divided by 9.
63,000 divided by 9. So what will be the new depreciation now?
7,000.
7,000.
It will be
7,000.
7,000. Okay. The time that we didn't do the revaluation, what was the depreciation?
5,000.
Okay.
5,000.
So what is happening to the depreciation now?
That's increased by
gone up.
2,000.
Increased by 2,000.
What is causing the increase?
The revaluation.
The revaluation.
Okay. In actual sense, the 2,000 should have been taken to where? In actual sense, what would the 2,000? In actual sense, the 2,000, the excess 2,000 should have been treated in which account?
The revaluation account.
It should have been treated in other comprehensive income.
Other comprehensive income, yeah. So
Yeah, because this particular 2,000, it is the revaluation that is bringing the 2,000. Are you okay?
yes.
But what we normally do is that we charge the whole depreciation to what? To profit or loss, including the effect of the revaluation surplus. Okay, so you can see that you are going to be understating your profit in the profit or loss account by 2,000, isn't it?
Yes.
So what management always do is that they will try to transfer the excess depreciation to retain earnings so that they can cancel that particular effect. So that is why you see that it is the policy of the company to make an annual transfer for revaluation reserve to retain earnings. They are doing that to cancel the effects of the depreciation relating to the revaluation surplus that was taken to profit or loss. So that is why you have been saying that excess depreciation. The excess depreciation is the original depreciation against the what? The new depreciation. You can see that the difference is what? 2,000. The revaluation has increased the depreciation charge in the profit or loss by 2,000. In that case, it is going to reduce our profit by 2,000. So how do we neutralize that? Let's go and transfer the 2,000 for the revaluation reserve to retain earnings because the profit for the year will be sent to retain earnings. So the issue will be cancelled there. Another way of also calculating the amount of reserve that you'll be transferring every year is to amortize the gain over the remaining useful life of the asset. What is the value of the gain that we have gotten? It was 18,000.
18,000.
What is the remaining useful life of the asset?
9.
9. So every year we'll be transferring what? 2,000 to retain earnings. This is the easiest way of calculating the amount that you're going to transfer. Take the revaluation gain, divide it by the useful life of the asset. The revaluation gain will be realized over the remaining useful life. So divide it every year, you take that particular amount. This is the reason why companies make annual transfer, because the revaluation is bringing additional depreciation, which should have been taken to other comprehensive income to reduce the revaluation to 16,000. The revaluation should have been 16,000. But in the revaluation results, it will be 18,000 then, because the profit or loss account is absorbing the additional what? Depreciation. So management don't want to do this. So what they will do is that at the end of every year, they will go and transfer the excess depreciation for the revaluation reserves account to retain earnings. So they will now reduce this one to 16,000. So sometimes they can tell you that it is the policy of the company to make annual transfer from the revaluation surplus of the company to reflect maybe unrealized profit or a realized profit or something. This is the reason why they are doing that. They want to eliminate the effect of the depreciation that the revaluation gain is bringing. All right. Let me talk about complex assets. Complex assets.
So please, can you explain it again?
Explain what?
Just from the depreciation, the second year, when we
Okay.
divided the 63,000 by the 9 years, we got 7,000.
Okay.
And so the depreciation has increased by 2,000.
Okay.
And you said it should be treated as a loss. Additional depreciation should be treated as an expense.
Yes, because that is the total depreciation for the year. But in actual sense, if we are not revaluing the asset, the depreciation should have been what? 5,000 every year, isn't it?
5,000, yes.
Okay. So since it is now 7,000, it means that what is bringing the difference?
The revaluation.
The revaluation. Where was the revaluation taken to? Other comprehensive income, isn't it?
Yes, please.
So it means that the 2,000 also should have been taken to revaluation surplus act, revalue other comprehensive income to reflect the depreciation for the revaluation gain. But we don't do that. We don't do it like that. We just take the total depreciation to profit or loss. It means that the depreciation taken to profit or loss is 5,000 for the normal depreciation plus the one relating to what? The revaluation gain. So what management will do
Yes.
is that if this happens, it means that our profit is going to reduce by 2,000, isn't it?
Yes, please.
Okay. So what management does is that they will go to the revaluation surplus account. They have 18,000 over there. They will go and transfer the depreciation that the revaluation gain is bringing from the 18,000. Then they will now send it to retain earnings. Retain earnings, so that, you know, in the retain earnings, profit for the year will be added to the retain earnings, isn't it? So they will now bring the 2,000 to retain earnings to now reflect the 2,000 difference that this was costing in the profit or loss account. So this has reduced our profit or loss for the year. This will now come and increase the profit for the year here. That is the transfer that they normally talk about. I hope you're okay now. All right.
Yes, sir. Thank you.
Okay, you're welcome. Let's come to complex assets. What do you mean by complex assets? Complex assets. Do you know that someone can purchase a building and decide to classify the building as a complex asset? Yes, I want to be mentioning names. Sina Augustine. Habakkuk. Complex assets, my people. What is a complex asset? Senior Augustine, complex assets. Antigradis, complex assets.
Yeah. Complex assets can be an asset that have different components or parts that have different useful lives.
Okay.
Hence, have to be depreciated differently.
Example is what?
Example is an aeroplane or a
Airplane.
lift in a skyscraper.
Why should you go and mention airplane? That is too much for me. Even the building can be classified. You can classify your building as what? As a complex asset. If you have AC, the AC is having a different useful life, isn't it? If you have a furniture in the room, the furnitures are having different useful life, and the building itself is having a different useful life. So you can decide to classify the property as a complex asset. So someone can decide to classify his story building as a complex asset because the lifter will be having a different useful life. The AC will be having a different useful life. The furnitures in the room will be having a different useful life. And the building itself will be having a different useful life. So the asset with so many components with different useful life is what we call the complex what? Assets. So the company can decide to classify the assets as a complex asset and depreciate them separately. Someone can also decide to classify his car as a complex asset. The engine is having a different useful life. The body itself, the seats in the car, they are all having a different useful life. So maybe when I buy a car, I will classify it as a complex asset. Okay. So that is basically about complex assets. Complex assets. Assets with so many components with different useful life. Let's talk about revision of the useful life of an asset. Revision of the useful life of an asset. Revision of the useful life of the assets. Assuming we bought an asset at a cost of 20,000. Okay, we estimated our useful life will be 6 years. Okay, after 2 years or in the third year, we now realize that the total useful life of the asset should have been, let me see. Okay, let me use 8 years here. Let me use 8 years here. 8 years here. Then after 2 years, at the beginning of the third year, we now realize that the total useful life of the asset should have been 10 years in all. How do we account for this? How do we account for that? How do you go about it? How do you go about it? Seniors, I'm waiting for people.
Hey, hello.
Yes, senior.
With my understanding, I think you have to depreciate the asset. That's you divided 20,000 by 8.
Okay. 20,000 by
20
8. Mm-hmm.
divided by 8, you get 2,500.
Okay.
At the end of the second year, you deduct that 2,500 times 2 from the 20,000.
Okay. And that will give us 20,000 minus what? 5,000, isn't it? That will give us 15,000. Okay.
Then I think from the third year going, that's the 15,000. You now depreciate it using the 10 years.
No, please. You have started well. Oh, my brother. The total useful life should have been 10 years. The total useful life should have been 10 years, not 8
Okay.
years. Okay. But you have used 2 years already.
Okay.
So this should have been divided by what?
8.
8.
Yeah. Sorry.
Okay.
Yeah.
Don't say that it should have been 20,000 divided by 10. You will now start depreciating like the 10 years was at the beginning. No, this is useful life that you are changing. It's a change in an estimate which should be applied what prospectively. So when there
Oh,
is
okay.
when there is a change in the useful life, what you do is that you start applying the remaining useful life from the time that there is a change. So for you to calculate the subsequent depreciation, it will be the carrying value as at the date that you are doing the revision divided by the remaining useful life from the date of the revision. That is how we do the revision of what? Useful life. The revision of the useful life. It's a change in an estimate that should be applied prospectively. Okay. I'm done. I'm done with the class. So I'll just solve question with you maybe next time. So if you have any question, you can ask. Okay, I want to ask a question. We all agreed that we are saying that any cost that you are going to incur on an asset before it is ready for its intended use, that particular cost should be what? Added to the initial cost of the asset. That's what we said, isn't it? Okay.
Yes.
Okay. Assuming you want to go and build facility in a company where they are saying that before you can build that particular facility, you need to pay you need to build a facility, you need to build a health facility for the community before you will open that facility or you build that facility there. If you are able to build a health facility for those people, how are you going to account for that particular cost that you have spent on this thing? How are you going to account for that?
On the what?
You want to go and build a facility in a community, and the people are saying that before they can allow you to undertake the project that you want to undertake there, you need to build a health facility for them before you can go ahead with your project. And you are able to build a facility for them at a cost of 50,000. How are you going to account for this particular 50,000?
I'm tempted to say CSR.
I also wanted to say grant.
No. They are not willing. It's not something that they are giving out willingly. It's not something that they plan to do. Are you okay? They are doing it because they want to open a facility there. So you can see that this is a direct cost to the facility that they are going to open there. If not for the facility being open in that particular community, this 50,000 should have been avoidable what? Cost. Okay.
Then it should be added to the facility.
Exactly. But before you can add this one, you need to ask questions. You need to ask the people, are they doing these things from their own hearts? Like, is it something that they are doing for the community, or they are doing it because they want to build a facility there? So it can be part of their corporate social responsibility if they are doing it willingly, or it can also be a donation that they are doing if they are doing it from like something like it's part of the social corporate social responsibility. But if not something that they are being forced to do it because of the facility. It means that although they are not going to operate within that particular facility, that cost should be added to the what? To the cost of the facility that they are going to put there. I hope it makes sense. All right.
Yes.
Okay. What question do I have again? I don't have any question. I have any question. Okay, so we say that whenever you have a maintenance, even if the maintenance will be every 5 years, the maintenance will be treated separately from the asset itself. I hope I have said that. Okay.
Yes.
Okay. So basically, that is all about we say that any asset that is being bought for owner's own use, or any asset that is being bought for administrative purpose, and it will be used in the company for more than a year, that particular asset should be classified as what? Property, plant, and what? Equipment. Or any asset that is bought not for its own use, but to help in the production of other assets should also be classified as property, plant, and equipment. So any asset that is for administrative purpose should be classified as property, plant, and equipment. But any asset that is for rental purposes should be classified as what?
Lease.
No, any asset that is
Investment property.
exactly. Any
Yes. Good.
any asset that is bought with the intention of reselling should be classified as what?
Investment. Or
Inventory.
inventory.
It should be classified
Inventory.
as inventory. So if you see a question, you have to ask yourself, the purpose will tell you which standard you are going to use for that particular asset. You can see plants or you can see land, and land will be what? An inventory. If the company is a real estate what? Company. Okay. All right. So if you have any question, you can ask. If there's no question, then I'll go back to sleep. All right. Do you have any question?
Nope.
Okay, I will share the questions that we are going to solve. I will share them with you before next week.
Okay.
Next week. Okay. Thank you all for coming.
Thank you
Thanks so
too.
much.
For availing.
You are very grateful.
Grateful for what? You have to be grateful to God, not me.
To God and to you
No,
for
no, no.
availing yourself.
No, no, me, I'm always there. It's because you don't know me. Habakkuk will tell you that I'm always there. Auntie Joyce will tell you that me, I'm always there.
All right, sir.
All right. Yo, senior. Eric,
My boss.
tell us up.
My boss, I do.
Okay, Mr. Fadi.
Yeah, they follow the teachings, Charlie.
Habakkuk, what are you doing
Yeah.
here?
I'm waiting for you.
You are just, you are the reason why Ghana, we are suffering. Oh. What are you doing in the FR class? I mean, you don't have problem with FR.
Oh, but we are learning so Abby.
Ah, go and write MA in full after you pass MA before you come to corporate reporting.
Or you still learn.
So you forget what is important and be learning what is not important.
Oh, but it's not. It's still important.
Really?
Yeah.
Ayo, you'll be very fine.
Yeah, sure.
Hey, Auntie Joyce. Okay.